Hyliion stock has been trending in popularity recently, and a lot of people are wondering if they should be buying more, sell what they have, or stand on the side and wait for a better timing. As the market is still very volatile at the moment, we should be mindful about the stocks that we pick, as well as their exposure and the timing. Over the past few days, the price action of Hyliion has brought the stock to $3.77 before stabilizing around $3.41. The short-term price action of Hyliion has been ranging around the $4 level in an overall difficult market, and it is also affected by the gradual decline in shareholders' interest, which was fueled by hype about the alternative energy generation and capital flight into the EV sector back in 2020. In general, the stock has been showing a lot of resilience from a fundamental perspective and kept working on its ongoing projects. Hyliion has also been one of the few companies not affected by the negative news that have been damaging the reputation and the price actions of many other EV stocks. When we look at the long-term tendencies, I would say that the signs are actually pretty encouraging. The stock has been able to mostly hold its ground since the beginning of the year around $4, and since then, Hyliion has been trying to reach new highs, with a handful of shareholders still trading the stock, with mixed results. I think that the stock is now in a new phase and is looking to reverse the bearish trend, and that overall, there are more reasons to buy Hyliion now than there has been for quite a while. With that being said, let's also take a look at the technicals and see what they're trying to tell us. The trading volume of Hyliion has recently been 2.4 million shares, with an average volume of 2 million shares. Over the previous 52-week period, its price fluctuated between $3.28 and $13.58. The market cap of Hyliion is currently at $586 million versus an enterprise value of $706 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the asset value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many other companies. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or grow faster, because it may have a better management, a stronger brand recognition, and a bigger online following. It is what makes it unique, in particular compared to an alternative competitors. In other words, it's not a tangible asset that companies may use. It is, however, the reason why many companies are perceived to be trading at a discount, as the market cap is lower than the enterprise value, especially in difficult and volatile situations. If the company goes to liquidation, the goodwill would be gone, and we would be left with potentially far less assets to distribute to shareholders and debt holders than whatever we see currently on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 2.5% higher than the 1-month low, 2.5% higher than the 12-week low, and 2.5% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 83%, compared to the historical volatility of 70%. The put-call volume ratio is currently at 0.07. It's normal for many stocks that tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 1.3 thousand contracts a day, versus the 30-day average volume of 1.4 thousand. In terms of open interest, the most recent volume of open interest has been 57,000 contracts versus the 30-day average of 42,000 contracts. In terms of the shareholder structure, institutional shareholders own about 29% of the outstanding shares, and the biggest shareholders include Vanguard, BlackRock, and State Street. It's relevant to understand the shareholder composition of a company because this helps us to determine if you should be holding the stock long term or to be trading it short term. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as an investment and not just a trade. This is obviously subject to a lot of exceptions, since there are many great companies mostly held by retail investors as well. But so far, that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, this could be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 12% of the total float, and 60% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of the short volume coming out of the dark pools, this is a suggestion that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation is to consider buying a position now, no matter how small it is, and to hold it for the next 12 to 18 months. Now, keep in mind that nothing guarantees that the price will go up, but when we look at the price evolution over the past few years, it's reasonable to assume that there is way more upside than downside. I would recommend to commit between 1 to 3% of your portfolio in total, and for now, I would also recommend to split the allocation in batches of 20% at a time so that you can purchase more in retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.